Time for our On the Radar segment when we track something in the markets that our guests are watching closely. We're joined in studio this hour by Greg Taylor of Purpose Investments. And Greg, you, like a lot of people, have been watching this record run for gold. And yet when you look at the gold rally, it is starting to give you pause on whether or not the huge gains we have seen are going to continue in the same way, shape, and form for investors. What's your analysis right now?
Well, as much as anything, it's you just have to remember why you own gold in the first place. And gold is kind of a diversifier that you're supposed to have in times of distress, in times of volatility, in times of macro headlines, and that's why you have it in your portfolio. And that's what we're getting right now. And you have to remember, this is an insurance policy at the end of the day. So when you're having something that actually is doing what it's supposed to, you have to make sure that you're actually locking in some of those gains. So I think, as much as I'm a believer in gold, and I think it again remains part of your portfolio, it's not a bad idea to start trimming some of your positions here. I think they've had great wins, and I think you want to make sure you're not round tripping this and having them roll over in case things start to get better. Some of the craziness out of Washington goes away.
Well, the material sector in Toronto trading this year is up about 20%, so huge move. It's one of the reasons why the TSX itself is positive in 2025. And then you've got a number of mining stocks that have seen gains in some cases that are double that amount. One thing I've heard from people who are bullish on gold stocks is they had traded at such a discount for a long time that it's kind of the argument, same way people would say, well, NVIDIA keeps growing its earnings, so the stock is still cheap. They'll say gold stocks have run up a lot, but the valuations still look good to me. How do you feel about that analysis?
Well, it is true, and I think there's a big divergence though between the producers, and absolutely the gold companies have lagged the commodity. We've also seen the seniors outperform the juniors a lot, and gold cycles tend to usually end when the seniors start buying juniors. So this might not be a bad time to start taking some out of the seniors, putting them to juniors, and maybe getting some of the M&A gain, because M&A has to be coming. There just hasn't been enough exploration done by the seniors in the last few years that to fill out that pipeline of projects. They haven't got anything in their system, so they're going to have to start buying some of the mid-tier and juniors to fill that gap. So I think within gold, you can do some rotation out of seniors into mid-tier juniors. And the other trade within the commodity is it's always that silver always plays catch up after the big gold move. So we've been advocating to move some of your gold position into silver as well. So as much as gold's done what it's supposed to, and I don't think you want to get fully out of it, there's different things you can do just to manage your exposure to hopefully catch the next leg. Okay,
so let's talk about not just managing what to do with gold and gold-related investments after the run-up. Is it suggesting to you that there might be better uses of capital or other areas to be looking with your capital just because this has already gone so far?
Well, I also think you can play lead lags across sectors, and that's I'm a big sector rotating fan, and I think as much as gold's done well, it really does start to feel like it's in the late innings of this rally that might get to 3,300 as Goldman suggested, but we're already at 3,100. That's been a massive run, over 30% in the last 12 months. But you might want to lag into some of these sectors that are just lagging in general, and I think looking at some of the banks are looking interesting. And there used to be a trade that Bay Street traders used to do of golds in the banks, and I think people have forgotten about that rotation, but we've had massive moves in the gold stocks and the banks haven't really done too much. So I think it's not a bad idea to start switching to that out of the golds into the banks, and it could be a nice little mean reversion trade.
Okay, so I'm just going to take a quick look here at sector performance this year. So we talked about how the group that represents golds, materials, are up about 20%. Financials as a group in Canada, even though you heard a narrative about how the banks were doing relatively well, I think you have to sort of look over a longer period of time for that. This year as a group, they're actually in negative territory.
Yeah, when you look at the states, they've done worse, as JP Morgan's off 20% from its recent high. So I think this is where you can look at the sentiment factor that everyone is so caught up in just the tariff headlines and stuff, uncertainty coming out of Washington, that investor sentiment has just gotten so bad that people have been allocating to gold and kind of chasing this trade. But you kind of want to look at where the puck's moving next. And as things start to ratchet up, maybe Trump starts to turn away from tariffs to some of the good stuff with tax breaks. That could cause a shift back into some of the sentiment, the areas that do really well when investor sentiment does improve, and the banks are one of those areas.
So not to put you on the spot, and not that you can have an answer to these unanswerable questions, but even looking at the tape this morning, it feels like beyond investors selling auto-related stocks because of the latest on the tariffs, this latest move seems to be reinforcing the investor concern about slowing economic growth. And what's not clear to me, we talked to all the economists and hear from the central banks, at what point, if even if the tariff story is resolved, at what point has enough damage been done that the economy just can't recover enough in the short term, even through policy like, friendly, taxation for the rich in the United States?
Well, and that's a concern. And I think even getting more micro on that, I think we're going to find out in the next few weeks with earnings season coming up. There's been a lot of concerns of just how the earnings are going to be at the corporate level, and that ties back to the economy. And I think right now there's just so much uncertainty that we're hearing CEOs and CFOs say that they're scaling back on CapEx spending. They're seeing the consumer be more prudent and not spending as much in the last few weeks. So I think you are going to see a slowdown, and I think that's the balancing act right now, and we're starting to see that in bond yields. There's been a big move lower in bond yields, and I think that's more on the slowdown fears more than anything else.
All right. Well, we've also got to watch the